Alrighty, folks, we got to have a conversation about the broken housing market. We are having more and more individuals come to me saying, Zuber, I get it. You're right. Thank you. But darn it, how long is it going to take? So we're going to have a great conversation with Mr. Jonathan Twomley. We're going to look at what I affectionately call the 54-year spreadsheet, which has economic data sourced back to 1970. And we're going to take a chance at looking at just how long it might take. How you doing, sir?
I'm doing great, Michael. Good to see you.
Absolutely. So this is actually something you and I looked at, I think about a year ago or so, kind of
Yeah,
just understanding what it had. I'm going to assume the audience has not seen it. So some of this for you will be a repeat. But let's get into it. Let's kind of break down how long the housing market is going to be broken or could be broken. So, folks, again, if you don't know, I believe this spreadsheet has so much value in it. I give it away for free. How do you get your copy? You simply go to onerentalatatime.com. In the lower right corner, it says 54-year spreadsheet. Click on that box, give me your email, and bingo, bango, you will get this in your email. Just to give you a lay of the land, what you will see down the first column or column A is all of the economic metrics. Across row one are the years starting at 1970. We've just added 2023. For those of you that want to geek out in data and maybe check me and see what I'm doing, congratulations. Every
mm,
record has a source, many of them being the St. Louis Fed, some of them being, NAR or St. Louis Fed. All of the data is there. Go nuts. Put in your own data, add data, whatever you want. So, and then of course we got graphs and all kinds of stuff. But let's get into data. Again, this spreadsheet is yours for free, for free, for free. So, Jonathan, you've seen this before, yes?
yes, I have. It's been a while, but this is a very cool spreadsheet.
Yeah, again, it allows you to, it's all kinds of stuff. It's got wages, it's got inflation, the misery index, it's got stocks and GDP. But what I want to do is we're going to focus on home sales. So
Okay.
let me just let's kind of get in here and we're going to highlight some records. And this is again for folks to have fun. So we're going to put those in yellow so they're easy to see. We should talk about let's highlight interest rates. We'll put that in a different color. Let's make that green. And what about inflation? We'll put that. Well, inflation's bad, so we'll put that in red.
Hey, and listen, highlight also the home ownership rate because I
Oh,
want to talk about
okay.
that later when we
Yeah,
get
I
through. Yeah.
love it. I like the homeownership rate, so we're going to make that purple because, of course, that's my favorite color, as my audience knows. Okay, so we're going to get into this again. And what I want to key on first is we're going to scroll over to 1978. We're going to make 1978 the first column. So why 1978? Well, 1978 is when inflation started taking off. Again, you can see it down in red. It's at 7.63%. We do have a mortgage rate at over 9.5. And we've done a total transaction sales of existing plus new home sales of 4.8 million. You see all of that,
Yeah, I
Jonathan?
do. Yeah. Yeah.
Okay. Well, guess what happened, folks? Inflation started to take off. Look at that. 1979, it jumps from 7 to 11. It doesn't get better in 1980. It goes to 13%. It's still double digits in 1981. 1981 is an important year, as you will see in a minute, because Paul Volcker comes in and says, that is enough. I've had enough. We're going to 18%. And then we break the back of inflation. It drops pretty precipitously, ultimately by 1986 being sub 2%. So this is the start of the journey. Inflation is hot. It's hot for a while. The Fed comes in and raises rates. So next we will look at what happened to mortgage rates. Mortgage rates, again, start this journey above inflation. It's interestingly to look at inflation and interest rates were about the same number in 1979, if you can believe that. So you were getting free money in 1979. Inflation was 11.25 and mortgages were 11.2. Again, it doesn't get better from there. It goes to 13, almost 13.75. Again, mortgage rates are up, again, just slightly above inflation. 1981, I told you 1981 was important. This is when Paul Volcker came in and said, I'm going to kick it in the teeth. It took rates to 16%, kept them there in 1982. kept them above 10% until 1990, folks. The 30-year mortgage was double digits until 1990. How many of you thought that was possible?
Yeah. And
So how you
listen,
like?
it's a great time to own bonds or just stick your money in a savings account. I mean, you were getting real positive interest rates on your money, uh,
Yeah.
just by sticking it in the bank.
But I really want people to see, again, inflation broke in 86. It went
Yeah.
sub 2%, but we had mortgage rates double digits for another 5 years.
Yeah.
But now to our question. We started this question with Zuber. How long is the housing market going to be broken? So we're going to go to this record. We are going to highlight this in its own color. We will make it blue. So I'm going to count the years for total transactions to equal or exceed 4.8 million. You ready, Jonathan?
All right, let's do it.
We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 years. So, folks, the housing market could be broken for a decade plus. How many of you thought that was possible? 1978 to 1996. 1996
Yeah.
is, and think about the population. Do you think the population in the United States was a little bit bigger in 96 than
Yeah, that's what I wanted to
1978?
know. Do you have the population here? That's what I
I
wanted to.
don't, but you know what? I will Google 1978. Why don't you pull out your phone and look at 1996?
Right.
Let's just partner on this. So, US population 1978. So I'll get the first number. According to a quick Google search, 1978, the US population was 222.6 million.
Yeah. So in 96, it was 269.7 million.
All right, so let's do a quick math on that. How much
41.
did we grow?
About 41, right?
Yeah,
40.
40. Yeah, I'm going to get the percentage divided
Yeah.
by 269.7 equals -1. We were only 17.5% larger.
Well, but still, it's a lot. I mean, it takes you that long to get transactions back to the same point. It's incredible. Yeah, and
So
even though interest rates fell, I mean, look at and what was
no,
between
exactly.
yeah, so between 81 and 96, interest rates fell by more than half.
Yep,
And still,
exactly.
yeah.
So, folks, everybody wants the housing market to be fixed in a month, a quarter, a year. I'm here to tell you it might take a decade. It might take a decade. It's
And here's something else I think that needs to be said as well. So
Mhm.
if you have the opposite phenomenon in this point, like in this period of time than you have
Mhm.
now, because in this period of time you had interest rates falling, right?
Mhm. Mhm.
And so people weren't locked into mortgages. I mean, a lot of people were refinancing throughout this period, right?
Oh, for sure.
Because I remember my dad bought his house in 1978, and interest rates were, if you go back, were pretty high. He just missed, so 9.64%, right?
Yep.
30-year mortgage. I mean, interest rates were falling during this period and the market was still not quite recovering. Now you got a situation where interest rates are higher and all these people are locked in.
Yeah.
So how long is it going to take to work that through the system?
Yeah. Here, I haven't done the math on this, but you want to see what's really funny?
Yeah.
So we just talked about transactions taking 18 years. What do you think happened to home prices from 1978 to 1996?
Oh, I'm sure they went up, but I can't guess as to how much they went up.
All right, well, let's find out.
Oh yeah, it's right there on the
Uh,
top. Yeah, so they went.
so median home price in 1978. Let's just highlight this again so people can see it. We'll make that orange. And oh, by the way, we're going to scroll over here to 1996 because that's when the housing market got better.
Yeah.
It was 139. So what, 139? I got
Yeah,
to
it's like
write
two and
this
a half
down.
times. Yeah.
Yeah. So again, folks, we can have a housing crash in transactions that does not lead to a home price crash.
Yeah.
People just don't seem to understand that, but I keep screaming it from the hills.
Yeah. You know what would be interesting is so you have the inflation rate,
I
right?
do. Mm-hmm.
So to compare the cumulative inflation rate over that period of time and
Uh-huh.
house price growth, right? I guess basically like what 19 so if you
I
had
right here we have nominal and real
yeah.
home price appreciation. So
So
real, let's do real. Let's do nominal first. We'll do nominal first just because it's fun. We'll
yeah,
just
what's
add this all up. We got to go all the way out to 1996. Sorry, folks, we got to scroll. 96. So looking at the bottom of the screen, cumulative 110%, average 5.8%. Again, folks, that's nominal, 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 not real. So now let's do real. All the way back to 1978. We got to scroll, scroll, scroll. There we go. We have 11, let's call it 11 and a half with an average of 0.6. Historically, over 50 years, the real rate of home appreciation is roughly 1% for
yeah,
50 years. 1% above inflation.
right, right. So real appreciation. Yeah.
Correct. So yeah, we did
And what
calculate that.
and so what was the cumulative appreciation, like the cumulative inflation rate over that time?
Oh, the cumulative. Okay, we have that. Where's CPI? So here we go. Well, it's got to be 100%, right? Just given the other.
Yeah,
Let's find out. Or
that'd be
maybe
close.
98 or something. I don't know. We'll find out. I have it, so we'll find out together. 102%. Yeah, it went up. Cumulative
Yeah,
appreciation. I'm sorry. Cumulative inflation was
right.
102%, and the average was, let's just round it to 5% between friends
So
a year.
basically the dollar dropped by half its value in that time, right?
Exactly.
So yeah,
Exactly. Yeah. Damn near exactly. Yeah.
yeah. So if you owned a house, you kept pace with inflation. So
Well, you actually
houses
did.
aren't based
In fairness, you did a little bit better because most people have debt, right?
right.
So it's levered, right? So you're putting 10% down, you get all the upside with only 10% down. But yes, I mean, like you basically kept up with inflation. Yes.
Yeah, if you bought a house for cash, you
Yes.
do a little
Correct.
better. You get 10% or 11% real.
Hmm. Hmm.
So yeah, that's very interesting. I
Well,
mean,
let's
good
see what
argument.
happened to stocks. I have stocks, man. This spreadsheet's got mass stuff in it. So let's do nominal first. This is stock. This is the S&P 500.
Yeah.
Again, it's always fun. How do stocks do? So stocks, oh damn, stocks went up 100 and let's call it 200%. Average return was 10%. So stocks look like they did a little bit better. And
Yeah.
now we'll do the real. Oh, it's a 96. Oh, too fast, too far. There we go. Where are we? 18% a year. No,
Also
yeah,
better than
18, a little bit better.
yeah.
One, and they got a full 1%. So not much better, right? Houses were 0.6. Stocks are basically 1%.
Yeah, but the compounding, I mean, you're talking the sum, they got
Yep.
18% versus 11. But the
Mhm.
thing is you can't leverage stocks. Well,
You
you
can't
can, but I
lever
mean
up. Yeah, it's not.
yeah.
You can't lever up, certainly. Yeah, so that's why when people do stocks and real estate, I like that's kind of comical, right? Because I can get 90% leverage in real estate really, really easy, and you can't
Yeah.
really do that in stocks. But yeah, well, let's look at GDP. How about that? That ought to be
Yeah.
interesting. So I only have the GDP rate. I did not create a real version of that, but let's see what GDP did. Oh, GDP was terrible. It's up 60%, not inflation adjusted. So, wow, inflation adjusted, that means it was negative.
Mm.
Ugh.
Well, I wonder how that's calculated though. Is that calculated?
GDP is not inflation adjusted number. No, GDP is always nominal.
Very interesting.
Yeah. All right. Last thing, let's look at unemployment. I'm just curious what happened to unemployment. So we start 1978 at 6%. It spikes in 82, which again is the year after he took rates up, stays above 9%, stays above. So when did it? So it got below. So below 1978 was 10 years. So unemployment got better in a decade.
Yeah. But listen, I
Uh,
mean, it didn't start, but I mean, I don't know about you, but I remember as a kid and like a young man that 5% unemployment seemed like a really hot economy. Remember that?
No,
Because I'm
oh, dude, I have an econ degree. I
yeah,
studied economics in college. So that would have been like 90 to like 95 or something.
yeah,
And 6%, Jonathan, was full employment.
yeah. I
That
remember.
was I was
Exactly.
beaten on that.
Yeah, I remember like talking about what they were debating what the full employment number was, and it was like five,
Yeah.
6%.
Yeah,
You know, and
exactly.
I remember taking like economics 101, and then they were and having them talk about because it was like I was not an economist, so all this
Mhm.
stuff was foreign to me. I remember them talking about like, well, you want to have unemployment around 5%. I remember like, well, why don't you want to have zero unemployment? Why do you want to have? It seems horrible, but
Yeah, exactly. No,
yeah,
listen, nobody should be unemployed.
yeah. So yeah, just not understanding that it's like yeah, it's just frictional unemployment. There's always going to
Yeah,
be something.
yeah, yeah, exactly,
So
exactly.
yeah,
So,
oh, but I wanted to go back to the home ownership rate.
oh yeah, let me go back there. Sorry, I can do that. I still have it. There we go.
Because I wanted to, and just let's look at, so the homeownership rate, just sort of scan it. So basically 64, 64, 65,
Yeah,
65, 64, 63, and
yeah.
just keep on going out, like just scroll all the way out and
Hmm.
just 64, 64, just keeps going,
Yeah,
64, 65,
yep.
starts climbing a little bit in the early 2000s because the government was pushing
Hmm.
homeownership. So you get to 68 and
69, 2004, I think was the peak.
yeah, yeah. And then
You know,
you're
bad things
65.
happen.
So
Yep. Yeah.
yeah, but I mean, it declines a little bit. Then we're at 63, and then back at 64.
Yep.
And so what I want to know is, Michael,
Uh-huh.
where is Renter Nation?
Exactly.
Where is Renter Nation? Where is it? I can't find it. I can't see it anywhere. They keep on telling me that we live in Renter Nation and
No,
that
and what's really wild is it's gone up for three
yeah,
years in a row.
yeah. As the multifamily industry keeps on insisting that we live in Renter Nation, I
Mm-mm.
mean, it's unbelievable. You're probably not following these debates as much as I do, but the constant drumbeat from the talking heads and the casual talking heads
Hmm.
in multifamily land is it's renter nation, folks. Nobody owns a house anymore. Nobody wants
It's
to own a house.
it's
Nobody
just
can
math,
afford to own a
Jonathan. It's just math.
what's that?
It's
Yeah,
just
it's just like
math. It's not true. It's just fundamentally a lie.
and then they're like, well, but look at young people. They're not buying and like, well, yeah, but young people always have a
Yeah.
lower home
Yeah.
ownership.
When you were young, you didn't own either, stupid.
Yeah, exactly. Like I didn't own a home when I was 25
I
or
didn't own a home
30.
until I was 31.
Yeah, I didn't own a home till I was like 36. So it's the whole idea is, and then yeah, and like, well, the baby boomers are owning all the homes and the young people can't buy them. It's like, well, the baby boomers are going to die. Like,
They all go out the same way.
yeah, like they're going, those homes will be passed on to other people.
Yeah.
And like it's and frankly, and we have, our population growth has peaked in the US anyway.
Mhm.
So it's like there's the whole idea that we're turning into renter nation and we're going to be like you know
No.
and
If
then
we,
somebody
yeah. So I actually, again, I mean, I geek out on data. So I did this whole high, low, median, average thing in home ownership rates right
oh
here.
cool we've already
It
done it
peaked, yeah, peaked at
yeah
69, low 63.4, 2016. Here's the 54-year average. It's all there.
yeah and where are we now what's the right now is on the right is this current we're on the right
So yeah, well, it's current. I only go to 23, so I don't have
okay
24 day.
all right.
I do. This is a yearly. I don't update this monthly. It'd be too much.
I'm going to see actually current US home ownership rate I bet you there's statistic there's
Oh,
noise and
it's noise. It can't move that much. Can't move that fast.
I get that
I don't know. I have the data source. I think I listed for that. Home ownership rate, St. Louis Fed. You know what? Let's click on it. I don't know what happens on Zoom if I do
okay
that
so
though.
according to Property Shark
Okay,
the home
go ahead.
ownership rate on March 20th was 65.2.
Okay, so yeah, it's within.
According to Investor Perspectives, the fourth Q4 2023, 65.7%.
Yeah,
So it's, you know, the
not
whole,
renter nation.
yeah, the whole, it's just bouncing around that 65. It's just
Yeah,
bouncing around, right?
no.
Basically. So,
So going back to the very early part of this conversation, the housing market can stay broken a lot longer than you think. In this case, 18 years. Interest rates affect transactions, not price. Again, it blows people's minds. Yeah, the other thing, you know what's on the spreadsheet? Affordability. This is another one. Let's bring it back up. Home affordability. How many times have you heard it's so unaffordable, nobody can buy a home?
Yeah, all the time.
So I have affordability on here. Here we go. Let's home affordability. And let's make this, I don't know, we'll make this, oh no, that's, I don't want, sorry. I got clicked on the wrong thing. I want to make this fill. And we'll make it orange. What the heck? Home affordability. So let's go back and look at affordability in 1978. Again, the number doesn't mean anything. Just watch the trend.
Okay.
So in 1978, we start at 96. It gets worse.
Yeah.
And it bottoms here in 1981. Why would it bottom in 1981, Jonathan? Because mortgage rates were 16%.
So what is it? Sorry, what does this number mean though? This is the median price income ratio.
So basically it's income versus price versus interest rate. It's math formula you can see in the whatever this thing up here.
And so lower is better or worse?
Lower is worse.
Okay.
Higher means more affordable in this case. Yeah, so just watch the trend. It going lower, bad. Going higher, good. So again, it bottoms in 1981 and it gets better for years.
Yeah.
All right, look at this. Now it's over 100. And we were going out to 96, right? So again, 96 goes to 109 and gets better from there for a couple more years. Now people want to talk about 20, hey, it's so unaffordable. Again, what was the number? So what was the number? Sorry, I didn't mentally get it. So the low in 81 was 60. Let's just call it 60 for easy math. So let's go to the last couple of years. I lost my mind when people were saying in 2020 it was bad to buy housing.
Yeah.
Because it was mathematically, Jonathan, the best year in 54 years to buy a home. 2020 was the most affordable year in 54 years. Wow. And we have these housing clowns and doomers talking about a crash. Then these morons and idiots go, oh, okay. We got 2020 wrong. We still have a housing crash. You were in the statistically top 5 most affordable years ever.
Right.
Oh, wait. 2022. You are still just about the average affordability in 2022. Oh, no, wait. 23. Now you're heading to below average, but you are 50% above 1981. 1981 was 60. You are at now. How can this be? Well, rates in 2023 were 7%, not 18. Wages are up, from there, and prices. So again, this whole nobody can buy nonsense is just factually incorrect. The whole early 80s were worse than 2023. That's people just are like, they don't zoom out. And the other thing, again, I want people to hear this. 1981 was 50% less affordable than 2023. And Jonathan, we still did almost 3 million transactions.
Right.
We didn't do 0.
Yeah.
We didn't do 0.
Can you, one other, go ahead.
I was just going to come back.
Yeah, I was going to point out too that the transaction volume, right, is
that's where I was going.
Obviously, if you look at 2023 versus 2021, it dropped off the cliff, 2 million, but there's still 4.8 million, 4.8 million transactions. And you're right on the button on the average there, right? Almost
exactly.
So, what is the average? What was I going to ask? Oh, the average interest rate over 30 years is what? 7.74%.
Yep.
Right? So we're still below average. This, which is also, you just hear people complaining about like, oh, interest rates higher for longer. Well, how about like normal?
Yeah, normal for longer.
Normal for once, like it's just crazy. It's just every time I see somebody say, are we, higher for longer. Are we going to have higher for longer? I'm like, what higher? What's higher? Higher than
Yeah,
what?
exactly. Exactly. Yeah.
Yeah,
Yeah.
higher
So at
than
the end of the day, the housing market is going to be broke for a long time. Exist a trend. Don't equate transactions with price.
yeah,
Don't believe all the nonsense about affordability, this or that. It's like it's still going to transact, still going to have stuff. The housing market will be slower. It will be slower. If you are a motivated seller that has to sell and the property's not perfect, you're going to get a lower price because a
yeah.
slower housing market means you have to meet the market. But all these morons, dude, it pisses me off. These morons talking about a housing crash in 2020 and 2021 when 2020 was the most affordable year. 2021 was in the top 5. It's criminal what these doomers and idiots we're doing.
Yeah.
That's why we
Yeah,
have the spreadsheet. People can go get it themselves.
I love the your idea that that higher interest rates craters volume, but it doesn't crater price. And unlike with commercial, right? Then that's a different story.
Correct, because that's a different story. Yeah,
Because you're not buying because you need a place to live and you fall in love with
exactly.
whatever it is. Your math has to work for you to buy it. And so we have seen. I was there was somebody published something today on LinkedIn that surprised me that now Green Street is saying that um, the total multifamily decline in value now exceeds the great financial crisis.
I've heard that as well too. Yeah.
Which, I was surprised to see because it took quite a hit in the GFC, but I think there wasn't a run up in prices before the GFC in commercial property the way there was this
Yeah,
time.
the reason that multifamily commercial, really multifamily is feeling this pain, and we've talked about it, was the people constantly retrading the same asset,
Yeah,
playing the what I call the greater fool theory, right? Buy it, fix up 10%, prove value, sell it, prove value, sell it. And that all of that was, in my opinion, financial engineering
yeah,
that now needs to be wrung out of the system. And
yeah.
there's a lot of losses coming.
There was no real value created during that time.
Correct.
Just constant churning of assets.
It was financial engineering. That's all it was.
Financial
And now
engineering
it's
and FOMO, right?
yeah,
Because
FOMO.
things
Exactly.
change. I mean, because honestly, when I got into the business, and here we're getting a little off topic, but when I got into the business, I was I've been talking a lot about this recently, but the definition of value add changed, right? When I got into the business, value add meant you completely rehabilitated a property.
Mhm.
You went
Yeah.
you
Done.
took
You
your
were done.
entire rent roll. You went from one. You
Mhm.
went from one type of property essentially to another. You
Yep.
repositioned it. You
Yep.
raised it
And it
completely.
wasn't months. It could be years to do it.
Yeah, it would take 12 months. Like someone who knew what they were doing could do it in 12 months.
Yeah.
But then what happened was people started renovating a couple of units, saying, "Look what we did.
Yeah. You could do it too.
Look how much more rent we got,
Yeah.
and now you do it, but you have to spend the money to do it. So we're gonna pay you. You're gonna pay us the post renovation value, and then you
Yeah.
got to go do the renovation." And it
Yeah.
just
Not
completely
good.
changed. And then what people found was they couldn't actually make money by doing the renovations because they'd overpaid. So
Yeah,
they
they
had
overpaid.
to do a few more renovations and then get out quick, right? And
Make
sell
it
it to the
somebody
next
else's
school.
problem. Yeah.
Yeah, exactly.
All right. We're going to talk about this in video number 2. I have a theory and it's leaning on higher rates. So I'll get to that in a minute. But Jonathan, you do a lot of work on LinkedIn. Where can people find your work?
Yeah, please. That's really where I'm focused. My attention these days is on LinkedIn. So please come follow me, shoot me a message. Tell me you're from ORAT, and I'll accept your linking connection. But I post a lot of content pretty much every day over there, and just come and join the conversation.
Awesome. Thank you so much.